These are the best ETFs to build your investment portfolio with. I highly prefer investing in ETFs over individual stocks for the bulk of my portfolio because it requires no time to manage and is a great way to generate long-term wealth. There are over 6,000 different ETFs globally, which can be a bit overwhelming. So here are some of my favorites that have a very strong track record and are a great addition to any portfolio. Let's start with the first ETF, VOO, the Vanguard S&P 500 ETF. Because if there's one ETF everyone should be holding, it's this one. This is the type of ETF that Warren Buffett recommends for the average investor, which is about 99% of people. A low-cost ETF that tracks the performance of the S&P 500. The low-cost feature of such funds will prevent fees from eating into returns. VOO invests in the 500 largest companies listed on the US stock market. These include big names like Apple, Microsoft, Amazon, Tesla, and even Warren Buffett's own firm, Berkshire Hathaway. So why VOO? Well, for starters, the S&P 500 is widely considered as a benchmark index for the US stock market, which historically has been one of the best performing markets. By investing in VOO, you get exposure to a diversified portfolio of blue chip American companies, which makes it an ideal choice for long-term investors who want to grow their wealth over time. Because as long as the American economy doesn't collapse, the S&P 500 will always generate returns over the long term, and generally it is tough to beat the market. As I said, another benefit of investing in VOO is its low expense ratio. Vanguard, the company that manages VOO, is known for its low-cost index funds and ETFs. In fact, VOO has an expense ratio of just 0.03%, so you're paying only 30 cents per year for every $1,000 you have invested in this fund, which is extremely low. VOO is also a passive fund, which means that the fund's portfolio is not actively managed by a team of analysts and portfolio managers. Instead, VOO simply tracks the performance of the S&P 500 index. This ETF is pretty heavily leaning towards the information technology sector with over 26%. But that's just because the companies in that sector also have the highest valuations on the US stock market, especially due to names like Apple, Google, and Microsoft. And it's clear that technology has played a big part of the world's growth up until now. And I see no reason why that wouldn't continue in the future. So it's not a bad thing to have some or a lot of exposure to those types of companies. The second biggest sector is healthcare with over 14%, followed by financials with almost 13%. But with this ETF, you're getting diversification over more than 11 different sectors. Historically, VOO has performed really well. If you had invested $10,000 in this ETF when it first came out in 2010, you would have had almost $40,000 by now. The price currently sits at around $374 and has a compound annual return of 9.8%. So overall, this is a great ETF to get exposure to the S&P 500 with low fees and high returns, and an excellent choice for any long-term portfolio. If you don't have access to VOO through your broker, just look for a similar ETF that also tracks the S&P 500 with low fees. But for example, eToro, which is a great broker, one that I also use, is almost available everywhere in the world and has all the ETFs that are mentioned in this video. And I'll also leave a link for eToro in the description below. The next ETF is for those who are also interested in the US stock market, but want more than just the 500 biggest companies. And VTI is perfect for that. The Vanguard Total Stock Market ETF, as the name suggests, is tracking the performance of the US stock market as a whole. And because of that, it holds a little bit of all the nearly 4,000 stocks that are trading on the US stock market. Just like VOO, this is also a passive index fund ETF, which allows for the same low expense ratio of just 0.03%. And when you buy this ETF, you're basically investing in the American economy and betting that the US stocks will continue to perform well. And when you look at the past 50 years, that would have been a great bet, with only 10 of those 50 years ending with a loss, which means that 80% of the time when you invest in this ETF, you end up with more money at the end of the year. And especially if you give it a long enough time, it's almost certain that this ETF will perform well. Again, since VTI tracks the total stock market and the largest companies are tech related, it's also the biggest sector in this ETF with over 27%, followed by consumer discretionary with over 14% and industrials and healthcare with a bit over 13%. But of course, this ETF tracks the whole market, so you're getting exposure to every sector out there. The top 10 holdings are obviously going to be the same as in VOO, because that one holds the biggest companies, and these are also included in this one. So it's again names like Apple, Microsoft, Google, Amazon, Tesla, and so on. And in total, the top 10 stocks make up almost 25% of the entire ETF. So even in a highly diversified ETF like VTI, a huge part of returns will come from those top 10 stocks, which isn't a bad thing because they're all solid companies who have realized great returns over the last decades. If you invested in this ETF 10 years ago, your money would have almost tripled by now. And it's up more than 400% since its inception in 2001. VTI's price currently sits at around $202, and it also has a compound annual return of almost 9.8%. The Vanguard Total Stock Market ETF is great for any investor who wants to match the returns of the US stock market in a passive way with very low fees. But again, if you don't see the option for this ETF with your own broker, let me know in the comments below and I'll help you find something similar that is available to you. We have one more ETF to go, but if you're getting some value from this video so far and you enjoy this type of content, be sure to subscribe and leave a like so I'll know to make more of these types of videos in the future. So far, we've only covered US focused ETFs. And as I explained, the reason for that is because it's been the best performing market historically, and it's also the biggest market out there. But that doesn't mean that there aren't great companies outside of the US as well. Also, while US businesses are the most dominant in the world right now, that could change at some point in the future. And other economies like China, India, and especially some third world countries have really been growing and are projected to keep doing so in the future. So if you're interested in getting exposure to countries outside of the US, the Vanguard Total International Stock ETF, VXUS, is a great option. This ETF tracks the performance of the global all-cap ex-US index, which are the investment returns of stocks issued by companies located outside of the US. So as you might have guessed, this ETF holds a lot of different stocks, with almost 8,000 in total. The expense ratio of this ETF is 0.07%, so a little bit higher than the other two, but still very low. You're only paying 70 cents each year for every $1,000 you have invested in this ETF. But like I said, if this ETF is not available to you, there are other good low fee options out there. You just need to look for an all-world ETF that doesn't include the US, because you already got that covered with the other two ETFs. The region allocation for this ETF is for a big part in Europe, with almost 41%, followed by Pacific and emerging markets with 26.5% and 25%. Of that, the 5 countries that are represented the most in VXUS are Japan, UK, China, Canada, and France. But it gives you exposure to companies from almost 50 different countries. When it comes to the sectors of this ETF, you're obviously getting a bit of everything, and it's not overly exposed to one particular area. The largest sector of this ETF is financial services with nearly 18%, followed by industrials and technology with 30.6% and 11.6%. In the top 10 holdings, you can probably recognize most of them, with, for example, Nestle, Samsung, and Shell. While in comparison, the top 10 of this one only accounts for about 9% of the overall holdings, which is much less than the 25% of the other two ETFs. This ETF is up around 60% since its inception in 2011, which is significantly less than if you would have held either of the other two ETFs in that same time period. But this is to be expected since it covers a much wider range of companies and countries, and it doesn't include the US, which, like I said, is the best performing market globally. VXUS is perfect for investors who want to diversify globally, and especially somewhere other than US stocks. It's simultaneously a hedge against the US economy slowing down and losing its number one place, and also a bet on other regions and countries improving their position globally and maybe even outperforming the US markets in the future. You can decide for yourself how much you want to allocate to this. If you're skeptical, you can also just skip it or just make it a small holding within your overall portfolio. There you have it. Those were some of the best ETFs that will give you a highly diversified but strong portfolio with low fees and almost no effort to manage. Let me know in the comments below if there are any other specific type of ETFs that you would like me to cover. For example, here is a video on some of the best dividend paying ETFs out there, which are great for those who are looking to earn some passive income through their investments. See you next time.